Just a reminder, everyone, that this video contains factual information only. It does not constitute financial advice. All right, so the other day on Facebook, and I've been actually for the last couple of weeks, been putting up some posts around Apple. All right, I talked about the fact that, Apple's obviously in an uptrend and you follow this channel, but when this channel breaks, the music's going to stop. And I talked about even the fact that, there's a possibility we might get it under $100 again. All right, to some that seems absolutely crazy because it's close to $200. There's no way Apple, the largest stock in the world, is going to drop 50%. What they don't realize is Apple is like every other stock, every other crypto. They all do the same thing. They all run in the same exact cycles. And if you actually just look at the fundamentals of Apple as well, the mean historical PE of Apple is over the last 10 years around that 19. All right. On top of that, we've been in an historic bull run during that time as well. All right. So during an historic bull run, when money was cheap, low interest rates, growth and technology stocks were thriving, it's had a PE of 19. So if the macro environment changes, maybe or even that PE would come down as well. We are currently at a PE ratio of 32, nearly 33. Okay, 73% above its historical average of a historic bull run. Okay, so my question was, what do you think it might go to if it even went back to the average? And then on top of that, also went back actually even more if we started to go into a bear market because conditions have changed as well. All right, so you've just got to, I know things seem crazy. Often at the tops of markets, things do seem really crazy. That's the whole point of it. They seem so unfathomable that it's not actually going to happen. And that's often why it will happen. Okay. And when retailers are saying you're absolutely ridiculous, that's crazy, it's never going to happen, that's where capitulation happens. Because if they're telling you that, that means you know that they're going to capitulate there because they can't actually believe that things like that might happen as well. All right. So I'm just going to go through history and talk about a few of these reasons and why it is a possibility and why anything can happen in markets and that you must be prepared for it just in case it happens as well. All right, so as you can see, that was a channel. Like I said, when it breaks the channel, music stops. And if you were following that and you were following that channel, it actually broke through the channel the prior day. And you would have known into earnings, you wouldn't have been holding that because it had already actually broken below support, broken the channel, and the TA had shown that it was actually breaking before the news came out. Howard saying, show me the news, I'll show you in the chart. All right, charts leading indicators. So we've had a breakaway gap down now, and now a strong close. The fact that it's breakaway gap and closed on the bottom of the range, that's quite a strong sell signal on Apple already right now. Now, the post I wanted to talk about before I start looking into the TA of Apple is I want to talk about the world's 10 largest companies by market capitalization over each decade. All right. So from 1980, 1990, 2000, 2010, 2020. All right. Microsoft was number one, now Apple was number one. But let's just actually unpack how all these actually turned out. So let's look at IBM first in 1980. It was the number one in the world in 1980. Let's check IBM's chart and see what happened. Okay, so looking at IBM, this is the beginning of 1980, this is the end of 1980, so 1990, and you can see that it was at around $13 mark, and it got up to a bull run of $40. But as you can see, it actually came down and retraced back down to $9. So actually, the whole decade of gains have been wiped out from that low there from $12. So if you had bought at the beginning of 1980, you've actually would be behind by the time it got down to here and it's wiped it all out. So what was number one in the world had a bit more of a run, but it actually ended up wiping out all that. I guarantee if you said to anyone in 1980, IBM's going to, crash to wipe out 10 years worth of gains, they would all laugh at you and think you're crazy. First one, let's check out the next one. So after IBM, we had NTT. So Japan will take over the world. And you can see, look at all these. All of these are Japan here. So actually, let's look at Japan, not just each individual one, because you're looking at it here like, well, that is, Japan's in a bit of a bubble here. Let's see what happened there. All right, Japan. Well, beginning of 1980 was literally the peak of Japan. We'd had an astronomical run up. Again, look at this run up. Went on for a long, long, long time. Astronomical. And then again, bet you no one would have thought if you would have said Japan's going to crash 90% and actually never, even to this day, have gone back. So 30 years later, you still, if you'd bought that top, you still haven't got your money back. But markets always go up, remember? Yeah, they do eventually, but you know, do you want your money to do nothing for 30 years going like that? So you've got to be careful when you know things are in an astronomical bubble. Let's look at how far this actually did ride when it went up, the percentage gains as well. And so looking at that gains, you've had about nearly 10. Oh, let's bring it back down here. Yeah, about 3,000%, around that 3,000% mark. Okay, and that spanned over. If you look here, we started around 60s, but really it started to push up, from here the 70s. So for 20 years, we started to then uptrend quite aggressively. Okay, in particular, the last 10 years. The last 10 years, you had 470% in that last 10 years. All right, keep that in mind for later on as well. Actually, let's have a quick look at Apple. So Apple in that last 10 years from '09 to kind of now, you can see we've gone up 2,000%. So Japan was in a bubble when it went that far. Apple's actually gone a lot faster, lot quicker. As you can see, astronomical, phenomenal gains really, really quickly. All right, IBM didn't end well. Japan didn't end well. Let's look at Microsoft in 2000. Okay, similar to Japan, Microsoft, when it began the decade, actually ended up being the exact top. All right, so Microsoft again had a crazy run up. I guarantee no one would have said that you're going to get a massive 70% crash on Microsoft when we were up here. Okay. However, when you have a massive run like this, and again, this comes to death, the market moves in three phases. Often, when you have a parabolic trend, you will then have consolidation for a long amount of time as well. As you can see, and what people don't realize is that Microsoft found its bottom on the tech bubble, and then it went sideways for 14 years. You can literally see, okay, we've come downtrend, we've bottomed, we've gone from $60 to $20, lost 2/3 of your value, and then we bottom and we go sideways from this bottom here, December 2000. We didn't break out of here until 2014. So for 14 years, Microsoft did nothing. Everyone thinks Microsoft is an amazing company, which it is. But if you had bought the bottom, or if you had bought anywhere here, you had to wait over a decade for you to do anything with your money. This was dead money for 15 years. This is what's called a classic spring from Wyckoff, which is where, if you think about it, you've got a major support. Where's everyone going to have their stop losses? Below that there. That market brings it down, grabs the liquidity from there, finds a bottom, the spring, and then comes back up from there. As you can see, bigger the base, bigger the explosion. When you have a nice big accumulation range like that goes over a decade, you then get massive breakouts. We are trending again, trending again, trending again, trending again. What do you think's happening again right now on Microsoft? Okay, again, 1, 2, you can see here we have shooting star, printing the next one. Let's unpack what the indicators are showing as well. So if I pull up our volume so you can see OBV here is printing a lower high, and price action has double topped to a bit higher. So you can see here you have bearish divergence off your volume. So sign of weakness, this has gone up and lower in volume here, now printing bearish divergence. And then if you look at your RSI, which is your price action momentum indicator, you've actually got triple bearish divergence. You can see from this point here, we've gone bearish divergence, bearish divergence, bearish. Okay, so we are definitely going up on weakness. So a couple of signs here that this is topping out and that we're going to be pulling back here. Whether that pulls back part of the range all the way down, or this is actually double top when we break all the way down, is what we need to keep an eye on. There is potential that, yes, that is a double top, but we need to confirm that neckline to break below there as well. All right, so a couple of really warning signs from there as well for your Microsoft, which, like we saw back in 2000, that one had topped out as well. Okay, the next one in the 2010 that was number one in the world was Exxon Mobil. So let's see how that went in 2010 for that rest of the decade and if it stayed number one and continued to perform throughout that decade as well. Okay, Exxon Mobil had a beautiful run coming up, high, low, kept going up. It was nothing but a left to right chart. Okay, then we had a bit of a correction, but in 2010 here, it was considered the number one country by market cap in the world. From there, we then had a bit of a rally going into, 2014, so the first 4 years of the decade. And then from there, same thing, we actually retraced the whole move from the beginning of that decade and actually went lower. So even if you had bought at the beginning of the decade at $57, it ended up going down to $30 and you'd lost half your money, even from the bottom of that decade, let alone if you'd bought something at the top here at $100, you've lost, 70% of your money off that as well. All right. So another one that has not performed well. So far, looking at all of our number one companies at the beginning of each decade, let's count how many were good. IBM crashed. Japan crashed. Microsoft crashed. ExxonMobil crashed. Okay, and we have Microsoft, or what is now Apple, is number one. What do we think might happen now? Judging off history, what is number one does not stay at number one. Why? Why does number one not stay there? Because the macro environment doesn't stay the same. Okay. Here, we're leading up. Japan had all the macro on its side. And then tech bubble was coming in, all technology, and then it popped. Then it was all of your commodities and oil started going ballistic. ExxonMobil started going well. It popped. Now, again, low interest environment, technology has been going ballistic, which is the FANG stocks. Again, if you look at the Nasdaq chart, okay, what has it been doing since 2010? Just nothing but crazy, crazy gains during that whole time. All right. Last time we had something like that was tech bubble. Okay. Same thing at SP 500 when we had a massive move like this. It was the Great Depression. All right. It's not normal for indices to do this kind of thing. That is not a nice steady growth. Steady growth is going at a 45-degree angle. 45 degrees. That is not 45-degree angle. Okay. So that's a nice healthy trend is a nice 45-degree angle. Let's compare. Let's look at maybe a key ratio that might help support this as well. Okay, we know Apple is part of the Nasdaq, the big boys that make up part of that. If we look at this is the Nasdaq to S&P 500 ratio. If we look at this ratio during the tech bubble, we were up around this point here. Okay, this is when technology was extremely overvalued, and people look back and go, "Oh my God, how could you not realize that we were in this euphoric zone?" Look where we are now. Exact same thing again. Okay, this is a ratio; it cannot go up forever. That means that Nasdaq is outperforming SP 500, and eventually that would mean that everything from the SP 500 is in Nasdaq, which is impossible. So right now, Nasdaq has been far, far, far outperforming the SP 500, which are your things like Coca-Cola, consumer staples, discretionary, and commodities and things like that. All right, so we are at extreme evaluations that we have not seen since the tech bubble up here again. Let's look at the chart and see if it's saying something similar as well. All right, so looking at our RSI here, you can see it's been divergent here, and even now we're up here triple topping, and RSI is still rolling over with some divergence as well. So it'd be really key to see whether or not we actually hold here, or if we start to roll over, we've actually got bearish divergence coming off this zone as well. Something that I am looking for, like I talked about steady growth, where might it come back to? Let's look where some key support confluency might be. Okay, so just looking at your steady trend growth, you can see we have a nice trend there. Okay, we are a long, long way off our trend. Last time we came off the trend, we came back to it. All right, so we have our trend line. Okay, one point of support. Let's look for some added confluency. So let's go from the bottom here and look if we have any Fibonacci retracements coming down. We can see the Fib 500. We know this is our pocket zone, 302 to 618, that we often get a reversal zone. All right, back down here, which aligns with this trend support. Let's also take it from the pivot from the tech bubble. See if we can get a Fib cluster. So you can also see, look at that, the Fib 5 and the Fib golden ratio 618 all aligned with that little zone right there, 618. So we've got powerful, strong support right there. Trend support, Fib 500 from the bottom, golden ratio 618 from the tech bubble. And then let's now look to see if there's any strong horizontal support there. You can see major resistance. Resistance became major support. So you can also see you have a strong support zone there as well. All right, so that's the kind of thing I look for, and I'm looking for, okay, there is a reason why a bunch of bulls would step in there. So if we start to roll over there, and again, if we start also looking at our target, if that is some kind of double top kind of thing, let's look where it might come down to. If it breaks, it rolls over, starts to break over here, where's it going to come down to? That target as well. All right, so massive confluency at that zone where if we do things start to turn over, Nasdaq starts to underperform SP500, and we some kind of double top, give it some time to roll over here, come back down. Where would it come down to? This is again a major zone. A lot of things showing that would be a good spot to eye off your technology and stuff like that. All right, so a couple of little things there, but main thing showing you there is technology. Last time we were up at these extremes was the tech bubble, due for a pullback. History shows number one, companies do not stay there because of the macro environment and the cycles. Things can change. Right? People think Apple is invincible because most people that have been in it have been in it for the last decade, which is when it's been in an extremely good environment for it to do well. Okay, here you can see this environment. Nasdaq SP 500 has just been high, 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 low, high. This is growth outperforming value. Okay, growth outperforming value, and then now all of a sudden we have double top broken down and possibly lower high. We're going with, we could be changing microstructure for the first time since the tech bubble for the last 20 years. Okay, so something to keep an eye on. You guys might be thinking, oh, all this TA shit's bullshit. None of it works. Da, da, da. I'm going to show you now on Apple how TA has worked literally to the dollar on previous times, like the tech bubble, the GFC, and how you could have actually pinpointed the bottom of them using technical analysis, using your Fibonacci extensions, things like that as well. All right, let's take a look now. All right, so here, this is Apple on the weekly chart, going back to, this is the tech bubble and then the tech bubble crash. Okay, and you can see we bottomed here or here, where we went. So let's just put a line there. Purple line up the top there is the top. And let's make that a different color, make that green. The green line was the bottom. Okay, so a way that you can actually find targets of where bulls and bears might step in is using your Fibonacci extension target. So coming over here, you got your Fib retracement, which is what a lot of people, this one here, trend-based Fib extension. You can actually find targets doing that. And how it works is you find the first point of contact, which is here. Then you find the second point of contact, which is here. Then you find the third point of contact, which is here, of the first wave. All right. So what you're looking for is from that first wave, from here, then when it pulled back, you can then project where that next wave is going to go to doing that. So you come over to your Fib extension, you left click, and then drag it up so the 0 is aligned with the top there. And then you can just bring it out and you can see where it aligns to. And I didn't click right on the very top of that there. All right. So you can see from there, and what you're looking for are 3 ones is where it often comes down to. The Fib 1 to 1 is often a good target here, the 1.618. And then if it goes past the 1.618, I often look at the 2.618. And that's when it goes into, 2.618 is normally an extended kind of bear market, which is what the tech bubble was. And you can see here that it came down perfectly. This is the 2.618 to the T here. That was the target for your ABC. Right, A wave, B wave, and then your extended C wave down to the 2.618. Right, so you using your Fibonacci extension, the only data you would have needed would have been this, and then all of this that played out, you could have known that this was a zone that you're looking for 2.618 for the buyers to step in. Again, like I talked about, you would have been looking at the one. Did any buyers step in? Nope. 1.618? Nope, no one stepped in. It actually became the resistance. But you can see buyers are stepping in. See how people were willing to buy here, buy here, buy here, buy here. So you know around that 2.618, people were willing to buy there. Maybe it was coincidence. Let's look at the GFC as well. All right, so this is the top of the GFC, December '07, and then we crash down and we bottom out in end of '08, '09 there. Okay, so same thing. We find our point of top. We then find our point of first bottom and then where it pulls back to. That's all we need. 3 points. From there, we can project where the next wave is going to come down to using our Fibonacci extension. So remember, come over here. We click the top, left click, come down the bottom, left click, bring it, align it up to where it is here. And then again, we're looking for our zones Fib 1 to 1, which again didn't hold, became a bit of resistance. This one only came down to the 1.618, not the 2.618. So remember I said it comes to the Fib 1, 1.618 or 2.618 are often your zones that you're looking for. This one came down literally to the T to 1.618 extension. All right, so again, you would have then seen that it was a demand zone. You can see buyers stepping in, then it didn't come down as far and then went up. All right, accumulation base off the 1.618 and then down to bottom and went up from there. All right, so again, you can see the 2.618, 1.618. These are all key Fibonacci zones to look for using your Fib extension. So keeping that in mind now, let's look at where we are right now and why we're at a zone that we have to be worried about right now. Okay, so here we are on the recent move from the bottom here. All right, so we've bottomed out here in January 23, and then we've gone up and up and up from there. And then we've just recently I put up that post knowing that we were probably going to reject here for multiple reasons. I'm going to show you why. All right, so again, knowing our points, let's pretend we've only got this wave and this pullback. How do we know where it might reject? So same thing, we'll just get our little circle. We know our bottom point. We then know our first top point. We then know our first pullback point. We can project using that extension where the bears might step in. So back to our Fibonacci retracement, click on the bottom, click on the top, click back to the bottom. Where has it come to? It's come to our golden ratio of 1.618. All right. So on top of that, we look at that. Oh, that's a zone where supply should step in, bear should step in. You can then see we also have an ending diagonal or rising wedge coming into that zone. On top of that, you can also see we were getting bearish divergence coming into that as well. So from here, on that rising wedge, we were diverging off our RSI. And then looking at our volume, you can also see that we made a new high in price action. We did not make a new high in volume. We have actually made a lower high. So again, showing that this is a fake move. Volume is not supporting the move when this made a new high. And now we've actually jumped down and we are coming back within. So this zone here, what was resistance, needs to now be support. If it's not, this is just a fake out, and then we'd be coming back down again from there. All right, so a lot of signs why this was looking a bit scary here. It has rolled over now. This is what's called a breakaway gap, when you gap down over a major support, and then we've continued to move down here. So little things to worry about here, unless we don't right now pull up from here and start to push up from here. All right, but yeah, just a few key signs there off that one. So looking at the big picture, let's say that was a top. Okay, where's this confluency support possibly going to come down to? Let's have a look at where there's a big point of zone where things might come back to. So I'm going to delete all that and let's take a look together. Okay, so you can see here Techo, and you can see, we've had quite a parabolic run. And the thing where people go wrong is they believe that, this stock or this crypto in the crypto world as well is different. It's like it doesn't follow the same parameters as every other stock and they're all the same. They all move in the same way. They all have three phases. They all go up, they all go sideways, they all go down. All right. Nothing is immune to having a correction and having a bear market, no matter how good the fundamentals are, because what they do is they actually overshoot. What you've got to remember, even with something like Apple, is this point right here, that was the top of COVID. This was the bottom of COVID right there. Look what it's done since then. It bottomed out at $53. It's now got to $200. 50 to 200. The largest stock in the world, $1 trillion business, has 4x in a couple of years. It is not normal for it's not normal for any stock to 4x in a couple of years, let alone the number one in the world that's $1 trillion company. That is just not normal growth. Okay, we know the indexes, the average is 7% a year. Why would the number one in the world go that far that quick? Okay, that is not normal. If you think about it, since that COVID there, and we've done a 4x, has revenue 4x since that point? Has it increased its profit margins 4 times what it did there? Because even at that point there, Warren Buffett of value investors still said Apple was too expensive, even there at the bottom of COVID point. That's why he didn't buy more there. All right. He himself even said, no, Apple's still expensive here. I'm waiting for lower prices. So what do you think he thinks it is now when it's up here at $200 when the revenue hasn't increased to match the Forex growth as well? Okay, these are the kind of things you've got to think about. If you look at like the post that I did about the PE ratio on Apple, okay, back here, the average PE ratio is 18.9, around 19, and that's why we've been in a bull market. We're now 33. The PE ratio does not justify, especially with the macro environment changing and us possibly going into a recession, all these kind of things, consumer discretionary spending going less. Again, if people are having a budget and worry about things, they're not going to be going out and buying the brand new iPhone like they have previously before. Okay, and that's if we're in a bull market. What would it mean if we go into a bear market, like I said? All right, in bear market, I can tell you now, things like Apple and that have gone down to low teens, if not single digit during that time, around the 12 mark. So it can actually go a lot less. So let's see if that's even possible on the charts as well. All right. So again, let's just look where the actual trend is. The trend is actually here. This was the healthy trend at about a 45-degree angle. Okay. And even from that trend, you can see we then went even into an even bit more of a trend up there. And then even that trend, you can see started to then go off like that. And can you see how it's just going into trend? It's just getting steeper and steeper, which is when shit gets parabolic. All right. It will eventually crash and then come back down. All right. So there, even this one is regarded quite a parabolic trend. You'd be looking for it more come down to these ones and these ones. Let's look at our Fibonacci as well from these ones. So going from our, what's this, the GFC here, from the GFC, for every push, you get a retracement 1/3 to 2/3 of the move. Where's the golden ratio? It would perfectly sit around this trend support here. All right. And where's that 70, $80? What does that also align with? Major resistance here as well. All right. You're probably thinking, oh, these Fibonacci numbers don't work. Let me show you using the log scale how much confluency you get with your Fibonacci zones. Okay, so from that tech bubble bottom, there, it's been in a parabolic trend here. And look at the Fibonacci numbers, what they all align with. 786 aligns with the top. The 618 golden ratio aligns with this major resistance that became major support. The Fib 500 aligns with this major resistance that became major support. The 382 aligns with this resistance that became major support. The 236 aligns with this major support. Okay, and now we are where we are now. All right, so see how the levels just tend to go there. they're drawn to these Fibonacci numbers. It's kind of how these things work. So what you look for is confluency, combining these things together. All right. So, it is not abnormal. Like, look, corrections that you can get parabolic, corrections you can get parabolic, corrections you can get. We have only really had parabolic. It would not be out of the question for it to have a bit of a sideways pullback and come around, for the next 5-10 years or whatever it is, going a bit of sideways to down here. That would still be very, very healthy for the number one stock in the world, which history shows us they never stay there for long. Okay, so things just to be careful of. Again, this is not financial advice. This is me just pointing out some things in history, pointing out where we're at now, not giving you buy signals or sell signals. I'm just showing you from the charts history and just what things to look out for in this point now. I actually want to also show you where we are within market sentiment and stuff as well. So, I like to have a contrarian view because, again, markets aren't designed for the common man to win. They're actually designed to take your money and put it into the Wall Street's pockets, all right? So really, whenever everyone's on one side of the boat, the market does the opposite. And if you look about where we are right now, market sentiment is extremely bullish. When everyone's extremely bullish, the market will often do the opposite. The last time we had bullish sentiment to this caliber, it was November 2021 before we entered the bear market. All right, so just the sentiment in general is worrying, ready for some kind of pullback as well. And then on top of that, let's also look at seasonality index of the volatility as well. You can see that this period now, August, September, October, seasonality is actually bearish. We get extreme fear and volatility coming into these months, which often shows that we're going to have some volatility around that as well. And then the year before presidential election as well is historically an extremely bad time during this August, September as well. And then it often picks up later on in the year, but it's just showing that the next 2-3 months is seasonality really, really bad as well, which is what TA is kind of showing as well. Let's actually unpack what the VIX is seeing as well and see if that is aligning with the seasonality itself. So this is your VIX here, and you can see we had a major support here. All right. So the bear market began here when we started to then push up bear market, and you can see we never really had that kind of blow off capitulation. Then we've come down. Everyone started calling it a massive bull market because we broke support. But what we've actually done is broke below, bit of a fake out, and we've come back up. And if you look at what that is, it's actually a double bottom breaking up there now. So it's come down, faked out, then tested resistance neckline now, double bottom, and then we've come up. And you can actually see from there, you can actually see that we've got bullish divergence going into that zone as well. So from here, you can see we're making lower lows, and then on the RSI, we're actually going higher. So you can see weakening trend going into there. It seems a bit of a fake out. We've come back within that zone while we're above what was a major support, back above it again. What that's actually showing us is that, this could be a bullish turnaround here, which means VIX is going to start spiking, which means fear and volatility is going to start happening on the market. So got to be careful while we're above here because volatility could be about to spike as well. So guys, hope you enjoyed the video. Just wanted to show you kind of how you can start this kind of just, think for yourself. You don't have to follow the herd and realize that markets go in cycles, and even the best of the best is not immune to corrections and bear markets, etc., like that as well. And just to kind of look at the bigger picture and see where things are at. If you liked the video, make sure you like and subscribe, and I hope to see you at the next one. Take care, everyone.